Thank you for joining us. You are in the Financing Trends panel today. I'm Kim Twitchell, and I'm the Senior Director of Affordable Housing at NBT Bank here in Portland. And with me today, I've got some banking experts. I've got Steve DeCastro from Maine Community Bank. I've got Andrew Silsby from Kennebec Savings Bank. And I've got David Hewlett from Port 51 Lending. So thank you. Our bios are going to be in the program that you'll find at the front when you register. Just scan that QR code if you want any additional information on who we are. But I would encourage you, and also the program, anything that was outlined today is going to be in that program as well. But our goal today is to really provide you with some insight in terms of the regulatory environment in the banking world today. And what we're seeing as far as the impact of the new administration. So we're hoping to provide a little bit of insight in terms of what we're seeing in that realm. Also give you some perspective on interest rates, what the banks are seeing from an interest rate environment. And then for anyone that's looking for financing, what can you expect the banks to be looking for when you request any type of financing? And like I said, we're going to try to save a few minutes at the end for questions, and we just ask that when you come up for a question that you come to the mic because we are recording this, and we'd like everyone to hear your question, especially for the recording. So I'm going to start, and what we're going to do here is just have a Q&A with some of the panelists. To provide some insight into what we're seeing in the banking environment. And I'm going to start with Steve. So Steve, can you give the audience a sense of the regulatory climate for banks and how you see that changing as this current administration kind of takes over?
Thank you, Kim. I get the fun one. Yeah, you know, it's whiplash, right? Like with many other things. As I was coming in this afternoon, I was thinking, 2 years ago, we were talking about bank failures, FDIC insurance, and then a whole litany of pending regulatory items for our industry. There's this thing called 1071, which is essentially a huge reporting mechanism around small business loans. There's an update to the CRA, which is Community Redevelopment Act. There were a whole host of other regulatory initiatives that were underway under the Biden administration that overnight have just gone away or on hold. So from the banker's perspective, that's helpful. There's a lot of things out there, as I'm sure you've heard from other sessions, that are less helpful, but from where we sit, it's nice to know that there's predictability. We don't have to adapt to some new reporting mechanisms that require us to invest in additional infrastructure to support our business. We can focus more on doing deals for customers here in Maine, and so I view that as a positive on the federal level. That said, you know, I've been around long enough to know that these things run in cycles, so we are constantly in a mode of it's quiet for now, but that will change. And then there's also what's going on here locally. You know, each of the different municipalities have different initiatives which create varying levels of opportunity and challenge, as I'm sure all of you are aware. And so overall, from a regulatory standpoint, it's a helpful environment for us, and I say that, you know, doesn't matter which side of the aisle you're on. There are other things, again, that are more challenging, but from a regulatory standpoint, it's helpful.
And Andrew, are you seeing the same?
I am. I think it's important for the borrowers in the room to understand, you know, the regulatory world. Why do you care about the banking world and the rules that we have to go by? You know, the FDIC comes into our shop and they randomly pick 40% of the files in our institution and they drop them on my desk and say, why did you do this loan? What's this? What's this? It's why we're asking so many questions. So if the regulatory, I call it the pendulum, it swings hard and fast, and it's swinging back the other direction. So I think we're a little more euphoric at the moment about where it's headed. But ultimately, just making sure that we can answer those questions and why we ask so many questions.
Yep.
Because I just have to be able to answer them. They're our principal at the end of the day, and I never know which file they're going to pull. It's a strange environment.
David, what about in your world? SBA lending.
In my world, I do SBA 7A loans. 7A loans are going to be for business acquisitions, partner buyouts, owner-occupied commercial real estate, working capital, the Swiss Army knife of government-guaranteed lending for small businesses. Why does it matter to you? These are going to be your tenants, your leasehold improvements, your ground-up construction, gas stations, etc. The past administration actually deregulated the SBA program in a way that had never been seen before, and it has been made very clear from the new administration that they are going to roll that back. The velocity of new loans last year was at an all-time high, outside of the pandemic year where they had a lot of 90% guarantees, which incentivized banks to do more risky loans. So we're going to see a lot of tightening of regulation in the SBA space. They had made loans under $500,000, essentially stated income loans, probably not a good idea. And defaults are rising at a rate 100% year over year. You're seeing fintech lenders come in and abuse that, just to be honest, they are. And lenders that, there's a Maine-based lender, and, not, pick on anybody, but this is probably a good thing, maybe. But in 2023, they had done $38 million in SBA loans. 6 months of this year, they've done $600 million. That is a function of deregulation. And the result and consequence of that is a defaulting increase, which has resulted in the SBA program being negative cash flow. And with the DOGE program and cutting cost, waste, fraud, abuse, it is fair to assume that there will be consequences to the SBA program. Hopefully they don't throw the baby out with the bathwater, but we're on the opposite end of the spectrum here. We're going to be facing more regulation.
Interesting. All right, let's move on. Last year, Andrew, we talked a lot about the inverted yield curve and what the impact that had on banks' margins. So today, 12 months later, the environment has changed. Can you explain and give us some insight into that?
Well, from a technical standpoint, it is not inverted anymore, so woohoo. However, let me back up. Yield curve, make sure everybody knows you're plotting interest rates over time. So short-term rates are generally lower than long-term rates. If you borrow money on a short-term basis versus borrowing it for 30 years, you're going to pay more for 30 years on a traditional, normal yield curve. That has been inverted for 793 days. That's 2 years, 2 months, 5 hours, but who's counting? It's a very difficult process for a bank. It wreaks havoc in the banking industry to have an inverted yield curve because essentially we're taking depositors' dollars and we're paying a lot more money for that and lending out either at a lower rate or the same rate, and we can't really pay the light bill if we over a long period of time. So the longer the yield curve is inverted, the more difficult it is for the banking environment. The yield curve has been inverted 10 times since 1950, 11 if you count the most recent current environment that we're in. And every single one of those times, when the yield curve comes out of inversion, we head into a recession. And so everybody, I think last year, were very concerned about a recession and that we would get into some difficulty. I don't think there's a lot of concern now about recession. That's been sort of pushed off. The Fed has always been chasing the elusive soft landing, something they have never done before, but they might actually pull it off this time. And so we don't really know what that means. I think this particular economic environment's really been caused by the pandemic and a lot of stimulus dollars coming into the system. That brought a lot of deposit dollars into the banking industry. Lending was pretty prolific out there, and so a lot of loans, a lot of deals were being done. Things got a little bit tighter, and now I think it's a little more interesting to see how this plays out. The Fed is in a really difficult spot because, and we're sort of going to get to this forecast piece, so I apologize for the long intro here. But the Fed's in a difficult spot, so they have a dual mandate. They've got to watch after inflation, and they've got to watch after the job market. And so if inflation is high, then they ultimately need to slow the economy down, so they've got to raise rates in order to slow that economy down. If the job market is not doing well and we have high unemployment, then they need to lower rates. So you see the paradox that they're in at the moment is whether we're gonna have an inflationary problem or whether we're gonna have a job problem. Well, you got an administration right now. Every single session I've been in today has talked about tariffs, and this one won't be any different. But depending on where the tariffs are, that would be inflationary and cause them to raise rates. And you've got an administration who's also downsizing federal government. And I read on the Wall Street Journal, it's $139,000 per job on the federal side. And so if there are significant folks that are out of work as a result of that, there's going to be a job problem. So the Fed's in this paralyzing position. So I personally don't think we're going to see a lot of change in interest rates. I think we're going to hover along. The Powell is definitely out there saying that he's going to, we're going to wait and see. I know James earlier talked about 2 rate cuts for the year. I'm not seeing it. I just don't see the catalyst for them to continue lowering rates, but we'll see how that plays out.
So the yield curve has improved, flattened.
It's flat. It's just flat from 1 month all the way.
The bank's margins have improved.
They have.
Because rates have had to go up on the lending side, and perhaps some of those deposits rates have come down. David, what are you seeing in your world?
I think that, most of my lending's tied to the prime rate. I'm unique up here, and y'all probably don't want a loan from me because of this, but my rates are variable. So, the past few years was quite a roller coaster for those borrowers. And right now, they've come down a whole point from, its peak. Rates peaked in, I think, like July 23, and they started to come down September 24. I think last year we forecasted like 75 basis points. We were pretty close. I think they overdid it. I don't think that they're going to cut. I share that sentiment. I don't see any indication, any reason that they would cut. But, I think every day is a new day these days. You open the news and a new government department is eliminated. They want to reduce federal jobs by 65%. There will be downstream effects of this. There's a money multiplier effect that will be impacted, and if enough jobs are lost, the rates could come down. But you got to ask yourself: is everything else okay? Right? Low rates are good, but is there as many customers to serve? So it's a double-edged sword. So that's I'm not betting on rate cuts.
Any additional thoughts, Steve?
Well, I was just thinking as I was listening to David Andrew that, I can imagine conversations in the different bank boardrooms that have happened over the past 18 months. And about a year ago, we were sitting here after a real severe short-term rate shock, saying to ourselves, we got to kind of pull back because we got to let our balance sheets heal. Our capital has been impacted by this rate increase at such a historic level. That has subsided, and the view now is we have a rate structure that makes sense for our industry. And so, and on top of that, as Andrew said, we may have found this soft landing, so we don't have a lot of credit issues, despite, except for what David was explaining, the SBA market. The conventional bank market is extremely strong from a credit standpoint. So we're ready. We're in a good position to lend into the future here. we just hope there aren't some external factors that turn things upside down, like tariffs and things like that. So that's what I'd add.
Okay, great. So as clients are coming, and David, I'm going to direct this to you, and then we'll go down the line. But as clients are coming to request financing, what are you looking for? What are you hoping that they bring you in terms of a request, and what's your perspective on financing a project?
We like to take a holistic approach, where it depends on the transaction at hand. I do a lot of M&A, business acquisitions, partner buyouts. Experience is key. There's a very, very common trend in our industry right now. It's called search funds. It's basically syndications for the acquisition of a business. Basically, a bunch of investors pool together money, and then they put up an MBA student to go buy a business. Hate that. But some banks love that, right? And, part of the recent changes in the SBA, which this is the baby I don't want thrown out with the bathwater, is they allowed for 0% down acquisitions of businesses so long as there was a seller note of 10% of the project costs. It's a mouthful right there. But essentially, you could sell your business if you're going to retire, sell your plumbing business, your construction business, your real estate business. You could sell that to your employee. Who better to run it than your employee? And you could sell it to them for no money down. And that was a great program that opened up a lot of access to capital for people who were the best suited to run a business, and they didn't have to go out with their hat in hand asking for private equity investors to finance the acquisition. I thought that was great, kept communities very stabilized. They knew the customers, the vendors, et cetera. So we love experience personally. The other end of the spectrum, we do riskier loans. Part of the reason I'm a non-bank lender. Port 51 Lending, we're a wholly owned subsidiary of Mass Mutual, but we're a non-bank lender. We don't get referrals from the deposits. You don't come into my office. I work from home. You find me when you get turned down by these guys. And so there's going to be more risk, and that's the whole premise of the government guaranteed loan program. You could think of the SBA guarantee as an insurance program for lenders. It insures 75% of the loan. So we're still risking 25%. So people may think like, why not just do the loan? Well, we don't want to lose $1 million, okay? So when we do a $4 million loan, we're risking $1 million. So we have skin in the game here. We're not just willy-nilly just shooting a money cannon that the government backs up. So experience, key. But the other end of the spectrum, the riskier you get, the lower your credit score, collateral. We are going to be required to lean up your house if the LTV of the loan is greater than 85% LTV. We do lots of 100% financing for real estate. Cash flow. We want to see projected cash flow that's going to make sense, minimum debt service coverage requirements. All this is probably foreign to you, but, minimums around 1.15. For every dollar you owe, you should be making $1.15 minimally. Experience, collateral, all banks love collateral, let's be honest here. Post-closing liquidity. I did a loan for somebody who a lot of other banks didn't want to do a loan for because she was in prison for 5 years for felony embezzlement. Big weakness. But their spouse made $2.5 million a year W-2 income, and they would guarantee the loan. So, it can be a holistic approach where you can balance one major weakness with one major strength. And the SBA programs allow us to lean into a bit of common sense risk, she had experience, don't get me wrong. So that's kind of how we look at it.
Okay, so when I think about how the traditional banks look, it's really not much different. But Andrew, you're a smaller community bank.
Well, definitely experience.
Yes.
I don't disagree with that. And then, cash flow. We want collateral is important, but that's the fallback. That's not the primary. So it's all about cash flow. I try to tell borrowers that you really need to think of us as investors. So developers, people who are doing projects, they do a really good job of catering to their investors, who are the equity stack that's bringing in the down payment. Maybe they're doing it themselves, but usually they've got somebody who's investing in that, whether it's mom or it's a true investor. But I like to try to get the borrowers to think, we're an investor too, and I'm not lending my money. I'm lending grandma's money who brought the deposits into the bank. And so we do have a different threshold to make sure that the loan gets paid back in the end. And cash flow is how the loan's going to get paid back primarily. So.
Any different approach, Steve?
Pretty similar. I did think to myself that we have a couple special customers we want to send to David, but the one thing I was thinking about is that in Maine, it's a broad-based market, so there aren't a lot of specialty areas, but there are banks that specialize in specific areas. I think about our organization. We have a specialty in low-income housing lending. I know you do that.
Really?
Kim. Yes, yeah, believe it or not. But there are little subspecialties like that that banks have developed expertise in, and so that's, as a borrower, as a customer, it's kind of good to be familiar with where some of those strengths lay.
Absolutely. And I think the other thing that's nice about some of the Maine bankers is the relationships that they build with their clients, right? And how important that is. And so it is about that relationship. So we can understand the cash flow,
Yeah.
the characters or experience, and then the collateral.
Kim, I would just add, too, that all the banks in Maine and across the country really have a different appetite for lending. And so they have specialties where they're, really good. But we do have regulatory limits. We have in-house limits in particular sectors. So, for example, if we're loaned up in self-storage buildings, the next self-storage customer who comes in may get a cooler reception. And sometimes borrowers sort of take offense to that. But the reality is, there was a conversation in an earlier session today where the self-storage had sold to a large Texas company. So the next morning, I may have plenty of capacity in self-storage again because some of those loans paid off. So that appetite is very different. This is going to sound a little dorky, but I equate this industry to those cooking shows. We all get the same ingredients, but we all mix and match and bake and cook and stir the pot a different way. And that ultimately creates a different environment for where we're really hungry for a particular loan because we don't have enough of those in our portfolio. And then we might be loaned right up in like self-storage, as I mentioned earlier. So just understanding that appetite is different every bank, and it's not personal to the borrower.
Right. One of the things they asked us to do was to outline some predictions for 2025. Where do we see the market going? And so we outlined, different quotes, so to speak, on where we saw the landscape for the banking environment. David, I'll have you go first in terms of, what were you thinking when you put together your prediction? Sure. Or you can just talk about it.
Well, one thing that I think we're all experiencing, or at least I'm experiencing, because I pay attention to the news too much, which is I wish I didn't. But we have this thing, Doge, right? And that's the elephant in the room. This is the variable that we have not had before. Let's be real. This has not existed before in this capacity. So when I wake up and brushing my teeth, looking at my phone, and I see that Elon Musk has tweeted that the Shady Business Administration, only 8% of the loans get repaid, I have a small heart attack because 98% of the loans get repaid. I would not have a job if only 8% of the loans get repaid. Millions and millions of people are digesting this information as if it's a fact. That's not a fact. So we have got to be cognizant of these things could disappear at any moment. I'm not saying that's going to happen because the Small Business Administration is a unique program that I think everybody should know here is zero subsidy. It doesn't cost us any money. When you get a loan from me, it pays a guarantee fee into the pool, and it is an insurance program that self-funds. It does not cost the taxpayer money until 2008 type things happen. And it's a net benefit. The jobs that are created, millions of jobs a year, are created. The small businesses are the lifebloods of our community, and sometimes there's loans that don't work conventionally. Not just I do SBA loans, but banks do SBA loans. They're a credit enhancement. It's a way to find a yes. It helps you get to a yes as opposed to get to a no, because a collateral shortfall is scary for a bank. And what that means is when the loan, if it goes bad, and let's think about restaurants. We've seen a lot of great restaurants locally close. There's not a lot of great collateral in that restaurant. That stove ain't worth much, right? So if we want to have great restaurants to eat at, SBA guaranteed loan programs are there. This is the number one industry that gets lent to. And so, my, what I'm focused on is just, advocating for the industry to remind people that this doesn't actually cost them any taxpayer dollars. It's actually incredibly efficient. We are what's called as delegated lenders. We guarantee the loans on our own behalf. The government then audits us to make sure we're not bad actors, like you're talking about, the 40%. They do a statistical pull, make sure everything's kosher, and then you get to continue to lend. It's actually quite efficient. It's a great program that has been bipartisan supported. But the challenge is the Biden administration actually did deregulate it a little too much, and fintechs really sent it with working capital loans. So if you want a working capital loan today, go get it, because it's probably going to get a lot harder in the next few months. If you want to get a 0% down business acquisition loan for your employee, go get it, because that's probably going away. And, some of these things probably should go away. But the whole program as a whole should not. And hopefully, we can advocate to our, politicians to keep it.
Okay. Andrew, what about you?
I wrote this a couple of weeks ago, so I had to reread it while it's on the screen because I got to remember what I wrote. Business investment, I think, is going to be slower. There are a lot of deals that are in the pipeline that have been rolling along for a while, but I see a lot of folks kind of on the sidelines trying to figure out the political landscape, what's going to happen with tariffs and whatnot. Again, we keep mentioning that word in nearly every session. So my sense is the first half of the year is going to be a little bit slower on the economic side, and then hopefully should pick up. As I mentioned earlier, I don't really see a material change in interest rates. In one of the last sessions, they talked about interest rates being relative, and they are relative. So, these are lower rates today than my first home that I purchased. But you ask somebody who's got a 3.25% mortgage, 30-year mortgage, they're thinking these rates are outrageous. But they are all relative.
Yeah, no, I would agree. Steve, what about you?
Yeah, we talked a bit about our thoughts around the lending market. The second part of my statement talks about mergers and acquisitions, and having just recently been through a merger, I get that question quite a bit, and I'll talk about it New England-wide and then sort of more locally. When I look more broadly, we're starting to see more activity of M&A, and it makes a lot of sense for a variety of reasons. One being that, as I described, that rate shock from the past 2 years, that's starting to subside. Banks' balance sheets are healing, so the ability to do a merger or acquisition is becoming more real for institutions. And the motivation behind that is, is severalfold. Oftentimes it can be management succession. It can be the desire to be able to grow with your customers. As we've been talking about inflation here for the past 45 minutes, and for us as a bank to keep up with you as customers, we have to have the capital to be able to do that project, which now costs 50% more. And so we need the capital to be able to accommodate that. So a merger or acquisition is one way to accomplish that, to be able to grow with our customer base. Also, cost of technology is and regulatory compliance is so high that to just build more scale helps with that for sure. So that's kind of the broader picture. In Maine, Andrew and I come from mutual savings banks. Maine is populated with a lot of mutual banks, and so they're wonderful. I love the mutual structure. It's, you're essentially owned by your depositors or your customers, so it's kind of a nice cycle of business for us. But it does make doing a merger or acquisition much harder, because you can't just say, well, we'll pay you more. So as So it takes a lot of elements to kind of to line up for a merger of a mutual to happen. So since Maine is populated with a lot of those, and those banks are all healthy, there's less motivation. So it's more challenging here in Maine to see more M&A happening, but bigger picture, I see more happening.
Yeah, no, I would agree with that. I think, overall, I think from an interest rate perspective, I agree with Andrew. I don't think we're going to see a lot of changes in the interest rates. I'm feeling from my perspective that, maybe we'll see another rate cut, but I think with all of the uncertainty out there, you just don't know. And so there's a lot of unpredictability right now. And I think uncertainty is hard when you're trying to do business. You don't want to have uncertainty. You want to have it kind of, know the rules. And I think we're just trying to figure it out. So I agree. I think we will see a slowdown or I think we'll see slower start of 2025. And then hopefully we'll see some rebound in later in 2025. But let's try to open it up to questions and let the audience ask some of our expert panelists some questions. Again, we ask that you go up to a mic. Try to keep your questions as succinct as possible because we'd like to try to get through a few. And by all means, go ahead.
In this year, $1.5 trillion worth of commercial loans are coming due. They're saying maybe as much as a quarter of those are ones that need a little bit of work. How are you as a banking industry addressing those? Is it force the refinance? Are you writing them down now? Are you trying to extend that loan? And what's your approach?
Steve, go ahead.
Yeah, it's a great question. I mean, there's the larger picture across the country, and then there's the local picture, and we don't see that. There's certainly some shadow space in certain markets. I assume you're talking about commercial real estate and office in particular, but I'll be honest. We don't see a lot of time bombs in portfolios that we have purview over, and our market here locally feels like it's adapted to some degree. Now, I'm not saying it's perfect, but we're not seeing that cliff that you read about in the Wall Street Journal and see in other markets to a greater degree. Not to say there won't be some painful conversations and challenging restructurings that will have to happen. I guess that's one of the benefits of being a community banker. You have such a tie to the sponsor typically that you have more options to kind of figure out a way forward for a troubled loan.
Anything else?
We're not seeing anything different than what Steve. I think I'm more worried about rate resets. We've been living for 12 years in a very low rate environment. We were talking about interest rates earlier. For 12 years, there was only one place rates were going to go, which was up. Today, it's sort of a 50-50 whether rates are going to go up or down, which was the beginning of my career. You didn't really know. There's more transparency to the Fed today in terms of interest rates, but I'm more concerned about rate resets than I am. And I think that's going to be a challenge. If a commercial loan happens to be at 4%, maybe we need to get them to 5 instead of 8 to try to make sure that doesn't blow up.
Anyone else?
You mentioned that some banks have their portfolio might be filled up with a certain asset class, like appetite for self-storage is satisfied. Is that information published somewhere? Is there like a secret code that you can ask a bank?
A great question. No, because the regulators have their opinions about concentration. Right. Generally, 25% in any industry is probably a good benchmark, but you don't know what we have in each of those industries. A lot of main banks are loaned up with hospitality, and some banks aren't, and so it's just and it changes overnight. That's the challenge. If there's a large payoff, it changes. So, we had an opportunity to take on a client in a $30 million project. Closed on 12/29, which helped our books and didn't help the other bank's books. But that changed our profile literally overnight in that particular industry. So, short answer, no, it's not published. But you can certainly talk with a bank about where their appetite is. I think most folks are pretty open with that.
I would say yes.
Yeah, I think it's incumbent to have a really good commercial lending team that's able to work with the customers to kind of project some of that. So it's like, so you know where you stand and have comfort that it's not just going to get shut off overnight. That's not a good feeling for a borrower, for sure.
And I would add too that, if we have a borrower, let's say in assisted living, and we're getting closer to our level, we're going to be a little more careful so that we can help that customer get the next property, as opposed to taking on the new customer. So you're always going to take care of your existing customers. That's sort of the dirty little secret. But you're always going to take care of your current customers. It's the new ones that may get a little colder shoulder.
And we often work together. Like, we have loans with Kennebec. We've got loans with other banking organizations. So we compete, but we also know that, we want to help businesses stay thriving and growing in Maine, and we're able to support that sometimes through combined effort.
I like to say we duke it out on Main Street for $250,000 loans, but when it comes to a $25 or $40 million project, we band together. Most of the bank CEOs will reach out to each other and have a conversation and try to make it work. It just disperses the risk. It keeps jobs here in Maine. It just makes perfect sense.
I'll just add, as a non-bank lender, we're not regulated the same way. So if you want to give me 1,000 hotel loans, I will happily do 1,000 hotel loans. 2,000 self-storage loans, please. And we don't take deposits. So if you love working with these two banks, you can continue to work with those two banks. We're not going to say bring over your deposits. We can't even take them if we wanted them.
Kim, we were talking earlier, or I was speaking earlier about heading into a recession, and there's one point I neglected to make. When a recession happens, depositors bring money back to the banking industry. So when the economy is roaring, money comes out of the banking industry, and so there's less money to lend. So when the Federal Reserve is jacking interest rates to slow down the economy, and we get shoved into a recession, dollars start flowing back in, and then the banking industry has got a lot of liquidity, so that when we come out of that recession, there's plenty of capital to be able to lend. And so when I said earlier, I'm a little perplexed because the Fed may achieve its elusive soft landing. The question this time around for me is, will those deposits come back? Because we've gone through a year and a half of very tight liquidity where depositors had taken a lot of dollars out of the banking industry. That's where the bank failures happened out in California. And so it's a little perplexing to me. This is kind of uncharted territory with coming out of inverted yield curve without a recession. It's a good thing, but it's got some question marks in my mind.
Sure.
What that means for us.
Absolutely, absolutely. Any other questions? Any other folks have questions?
I have a question.
All right, Paula.
I'm trying to connect some dots here today. So we heard that we need 86,000 housing units, and I've been reading about a lot of starts and all of that. Is the Maine banking industry prepared to support the loans needed to bring those housing units to fruition?
I think we are. I think deposits are important. I said that a few minutes earlier. We are using grandma's money that's in a CD or in a savings account, and we got to keep $20 in the vault so that when somebody comes on Friday for some money, we've got it available. The other $80 we're lending out, and that's banking 101. And so I think deposits continue to be important to bring in, unlike David, who's got dollars from a different source, but at least in the banking industry. I don't. I struggle a little bit, Paula, because I don't see us investing in first-time homebuyer homes. A lot of the activity is multifamily, it's rental, it's condos, but I'm just not seeing that first-time homebuyer, and I'm not sure there's enough profitability there. And I don't know that if the interest rate was zero, whether folks that would dramatically change the qualification. So, everybody has leaned in on housing and trying to make this a different outcome. Because we got to find, I lost track of the number, 86, 87, 85,000 houses between now and 2030.
And like Andrew said, that's going to be spread out over whether it's the consumer side where their consumers are buying homes or condominiums, or the multifamily where it's rentals that are being developed, and there's lots of different programs around various income levels associated with that. But we need housing at all levels, because let's face it, if you don't start loosening up, just let's say it's the affordable side, and you just do affordable, you've got to make sure you're also doing market rate. So it's a combination of everything.
And back to tariffs, the tariffs are really impacting that long-term bond rate, which is where mortgage rates are. I do think if we get some clarity around that, you might see mortgage rates come down a little bit as opposed to where it is today. If we could get to that 6% number squarely into 6%, I think things will start to break.
Anyone else?
Got a gap financing question for you, and a little bit of a plug buried in it. How often do you guys see a business borrower come in looking for, say, $100,000, and you're only comfortable providing $80,000? And how often do those borrowers get introduced to a non-financial lender, like a revolving loan fund, maybe like a town like where I work for, the town of Gorham, that has a revolving loan fund, or CEI or GPCOG, some of these other revolving loan fund programs? How often do you see, one, that they come in with a number that they want and you're not comfortable with that full number, and then how often do they get referred over to someone else to help fill that gap?
Yeah, it's a really good question, and it happens a fair amount. And it comes down to having those small business bankers who are aware of the resources that exist to plug them in. We have a couple at Maine, or more than a couple at Maine Community Bank, who know where to guide folks, but it can mean the difference between the business surviving and not, so that's an area as a community banker. It's really important for us that we have well-educated staff to help guide folks, because if they run into the wrong person, it could mean the end of the business.
On the flip side, I do see borrowers more informed than they were 30 years ago. There's a lot more resources, and so they come in with a better sense of the programs that are out there. I agree with Steve. It's still a little bit of a challenge there. Projections are always a bit of a challenge. The reality is, we sit at a desk and we're lending grandma's money. And I keep saying that, but it's not my dollars. It's the depositor's dollars. So we do need to be careful about that. So if it's based on projections, you're basically, as the borrower, trying to tell us, this is my dream, this is how I'm going to make it happen, and you're trying to convince us to invest 85 or 80% of the risk there. And so it's a challenge often. And so, we usually work as partners. We look at it as a relationship. We never say, no, we're never going to do this, go away. We always sit down and lay out some steps as to how we can get you there. And sometimes it may take a year or two, but ultimately, if the borrowers are willing to listen and go after some of the resources, then I think they can get there.
Anyone else?
I would say, Maine's great. Maine has, fame, it has, CDFIs, it has lots of local resources in an abundance per capita. Great banks, you go down Route 1 Falmouth and, skip a stone and hit 12 banks. If one doesn't got a good answer for you, I bet the other does. Nationwide is a little different. I don't know if the bankers in this room have seen this trend, but for that type of loan request, the biggest fear that I see is businesses going to MCA loans, merchant cash advances. It's basically a death sentence for small businesses. It's part of the reason that the SBA loan program did relax underwriting guidelines for loans under $500,000. That's why you've seen lenders balloon loans in the $100,000 to $150,000 mark, because it is very, it requires about the same amount of effort, sometimes more, to underwrite a $100,000 loan historically than it does to do a $5 million loan. In my industry, frankly. And so, there's not a lot of juice to squeeze at 100 or 80,000. So they needed to make the program more efficient. But thankfully Maine does have a lot of great resources, but it does become education because those MCA lenders are paid a lot of money to make phone calls to the small business owners that you're trying to support. And unfortunately, the local resources are not paid a lot of money to call on those same borrowers. And so it is a race to educate them of what is available before they get lured into the wrong product.
I would agree. I know we only got a couple minutes, Kim. I would agree. Square makes it super easy for a business person to take an advance on future revenue coming in, and the interest is so strong in terms of compounding and very dangerous. We've had a number of customers that have gotten into a lot of trouble. Folks think credit cards are trouble. I'm telling those advances are really, really rough.
Well, listen, I'm going to cut it short. I appreciate the good conversation. I appreciate you folks joining us, and thank you to our panelists for all your insights today. A few things. I do want to take the time to thank the MEREDA Gold sponsor, TD Bank, for all of the event sponsors. Also, our partners, Audio Visual, partner Headlight AV, and our PR and marketing partner Words at Work, and of course Shelley Clark, who puts this wonderful conference together. There is a networking and showcase downstairs that's happening after this panel, and happy hour, so I invite you all to join. The first drink is on MEREDA, and don't forget that if you are receiving continuing education credits, you have to make sure you sign out at the registration desk. So don't forget to do that. And please fill out your evaluation forms. We've changed the format of this forecast conference because we've heard feedback from everyone, and we really appreciate that feedback. So if you could do that, that's great. And the last thing I want to say is join us for our next morning menu on rezoning in Portland on March 20th, the Strikes for Scholars Bowl-a-thon on May 1st, and our Notable Night Spring Celebration on May 14th. So thank you again, and you guys all have a safe trip home.